think we're going to talk about some Thanksgiving prep and some non-government going back to work, and when are we going to see all this data that we've been waiting on?
Yeah.
Why does this market so resilient? You got Nvidia tomorrow. All eyes on Nvidia again.
Just so you know, I've got a bunch of charts which Jen's working on related to the credit card metrics or credit card profitability. So.
Okay. But
also talk about affordability. There was a dinner last Wednesday between Trump and the Wall Street executive.
I heard all about it. Talking about mortgages, how to get people into houses.
Yep, affordability is the word of the day.
Affordability, indeed. Well, Trump just Trump
just
lowered tariffs on coffee and.
Yep.
What's that?
Bill Ackman's supposed to come up with something big on affordability, housing, or something this week. And Freddie and
tomorrow at 10:30, he's got a forum. He was one of the attendees at the dinner. So was Paul, the two big GSD. I wrote about this on Sunday, and I'll share some of my thoughts.
Yeah, they're talking about the 50-year mortgage. They're talking about taking your mortgage with you. I don't know how that's going to work.
The portable and assumable mortgages are the potential big deals. The 50-year mortgage sounds like it's dead on arrival. It sounds like Trump is pissed off.
I can't imagine
that. But I think the assumable and portable mortgages are a serious consideration, and Canada does. I think Canada has portable mortgages. I'm not sure if it's portable or assumable, but they have one of the two already.
Assumable mortgages used to be a thing like 20 years ago. I vaguely recall when I was a mortgage person that that you could. There were some mortgages that were assumable.
Well, I wish I knew that, because I bought my first house in '85 and I had a 14.65% mortgage rate.
No, this would have been early 90s. This would have been early 90s.
But
I bought my first house on my credit card. So
the lineup this week that is sort of worth mentioning. So you got tomorrow, in terms of events to watch. But tomorrow you have the GSE forum that Bill Ackman is leading attention to. And then Wednesday you have NVIDIA's earnings after the close. But you also have the FOMC minutes from last meeting being released. And that'll be interesting to see what sort of discussion is.
Is that tomorrow or Wednesday?
Wednesday.
Wednesday's FOMC meeting minutes. Yep.
Yeah. Then I think on the 21st you have the sanctions on the oil companies. I'll defer to Bob for this, going into effect on the 21st.
Yeah.
And then on the 25th, Michael Burry is supposed to come out with some revelations about AI and data centers, and he's going to do a presentation. And then on
he's going to talk about data center depreciation again.
Yeah, I think so. And then on December 10th, you have the next FOMC meeting. So those, just looking at my calendar, those are some dates. I'm sure there are other important issues that I'm not aware of, but those are some important dates to keep, looking at.
Do we have visibility on when any of this government data that's been withheld is going to come out? Are they going to go back to the old schedule, or
in terms of date?
We're going to get to see any of the data that we didn't see?
Well, on the employment data, which everyone waiting for, they've talked about releasing the raw data, but none of no employment rate. So you don't know if it's going to 4.3 to 4.5, 4.3 to 4.1.
All right. Okay. All right, let's get this show on the road. Welcome to Wall Street Beats, everybody. I'm Steve Lamar. I'm joined by our financials and banking pro, Charlie Peabody, and our oil and gas pro, Bob Morris. Today is Monday Monday, November 17th. I hope everybody had a good weekend. Kind of quiet and cold here in the Bay Area. Doing a lot of turkey prep and football and not much else. How about you guys? What did you guys do this weekend?
Worked.
Yeah,
Went up.
that was the other part I was going to leave out, but
brought our
all right,
daughter
let's
home
get
for the
this
weekend
going.
from college. So
Let's get this going, Bob. What are you looking at this week?
energy, oils continuing to hug $60 a barrel here. News headlines keep bouncing back and forth either way. Last week they were down up a little bit on Ukraine hitting one of these Russian oil export terminals. That terminal's back up again today, so oil was under a little bit of pressure, although it's sort of flattish here around $60 a barrel. So, and we had it was essentially a bearish U.S. crude oil inventory figure last Wednesday. So oil's just continuing to hug $60 a barrel here. Not a lot of news that's going to move that other than perhaps some geopolitical event, really. Natural gas is holding in very well in their month contract, which is December, up close to 450. But we're watching the inventories and the weather very closely, as we've talked about before. U.S. natural gas storage is nearly 4 TCF, which is at the upper end of the bound of the 5-year range, nearly 5% above the 5-year average, just slightly below a year ago. We'll probably get another build this week when it's reported on Thursday. So, we're keeping a close eye on that because if the weather doesn't cooperate here, we end up with a warm winter. That storage level is going to look a lot like it did coming into this year when natural gas prices dipped into the spring. But again, I can't predict the weather. We're keeping an eye on it. It's still warm here in the Northeast, but natural gas prices are holding in very well. The natural gas names are doing very well, the ones we like, EQT, EXC. Still, I wouldn't chase them at these levels, but any sharp pullback, I'd buy them because we own them a lot lower. And C&Q, we talked a little bit about last week on the chart. It looks really good. It looks like it's breaking out here technically. Looks very strong. And so that's one we continue to like. And, people sort of poo-poo energy a little bit here. But if you look, and I was just running through some numbers, EQT's up 28% year to date. Expand Energy's up 6% year to date. C&Q's up 9% year to date. Chevron's up 7% year to date. EOG's been sort of the disappointment, which, I've been a bit lukewarm on EOG. They're down year to date. But, the energy names that we like that we've been tracking here, they're not NVIDIA and some of the tech names. They're not part of the Mag 7. But they've done, pretty well here, particularly given what oil prices have done and how we started out the year on natural gas. So I think that's encouraging from the perspective that I don't think there's a lot of downside to oil prices near term. Yes, there are a lot of bearish forecasts out there. I mean, bearish people saying it could go to mid 50s just on oversupply through the first half of next year. But any upside to oil is going to be very positive for these names as they continue to expand margins through efficiency gains in reducing hit counts like a lot of other sectors. So, I'm not doing anything right now because I'm very happy with the positions I have, but I would point out that, C&Q from the oil side of it technically is looking very good, looking like it could break out here from a technical basis. And the natural gas names continue to be very strong here, although I'd look to add to our overweight position on any sharp pullback. I wouldn't chase them here.
Bob, is this kerfuffle with Venezuela on your radar at all? Is that something?
I mean, we're watching it, but it's the market isn't concerned about that. They're not worried about
doesn't appear
whatever oil supply is coming from Venezuela being disrupted. And we've talked about the sanctions on Russia's two biggest oil companies coming on here shortly, and the fact that oil tends to find its way into the market regardless. And so, when that Russian oil export terminal got hit by the Ukrainian drone last week, oil popped a little bit, which tells you the market expects that that's oil that's getting into the market. And if it's interrupted, that's bullish for the oil price. But that oil tends to find its way into the market. It's more difficult and it tends to be discounted in finding its way into the market. But that's going to be there. And in Venezuela, I don't think anybody's concerned about any interruption to supply there. And it's
Okay.
certainly what the Trump administration is doing. They're going to meet. Apparently, they're now going to meet with Maduro. The last thing they want to see is oil prices run up. Everything's been working very much in their favor from an inflation perspective with where energy and gasoline prices have come down to. So they don't want to mess that up.
Steve, the way I played that Venezuela news is with Shell. And the only thing I can say, and I'm going to defer to Bob because I'm way out of my league here, but if you do install a U.S. friendly government, I'm assuming they're going to let some U.S. operations back into Venezuela, and I would assume Shell would be one of the major beneficiaries of that. But Bob, you may have some thoughts on it.
Yeah, and Chevron's got some operations or did there. So yeah, it's more on the major side, but that's longer term as far as getting back in there and getting any oil flowing and taking advantage of that. It'll be a longer term impact.
Any of your names, Charlie, with exposure there that this would have any effect on? No.
No, in the financial area, no, not at all. I mean,
Okay.
So I mean that whole region, they're different plays. I mean, there is a movement, similar to what you saw in Argentina, in Chile in terms of elections. So people are playing the lithium stocks on the long side, SQM and ALB. I mean, idea you'll have a friendlier, pro-business government. So, in Argentina, I played YPF on that, prior to the re-elections, which was an energy play that's done well.
Yep. Okay. All right.
Chevron's got the most exposure from the positive side of Venezuela, given historically they've been partners with PDVSA.
Okay.
But Bob, just in terms of the demand side, I think the IEA came out with some revisions recently on supply and demand. Can you remind us what those were? I was going to say something. I'm realizing I probably don't know, so I'm going to let you tell us what they did.
They came out. They came out with two scenarios. One saying demand would peak in, I think it was 2030 under sort of a base case, assuming a lot of these, I don't know if I want to call them green measures, but a lot of these conservative energy conservation or transition measures were instituted across the globe. But in a more practical sense, they were looking at a case where oil demand peaks in 2050. So, I mean, we're not looking at peak oil demand anytime soon, in my opinion. But the forecasts they came out with were interpreted a little bit bearish. What was even more headline grabbing was that OPEC came out with a forecast that was a little bit more bearish than they'd come out with before. And people tended to grab onto that forecast a little bit more as far as what they see in the first half of next year as a little bit of an oversupply situation.
Yeah,
and part of the reason why they paused this production increase that they've been doing for the past year, they paused that for the first quarter of next year.
I guess what I was hearing, and as you know, I'm a big believer in energy right now, but there was this sort of unaccounted for discrepancy between supply, demand, and storage of about 1.5 billion, maybe 2 billion barrels a day. The thinking amongst some of the people I talk to is when you have that sort of discrepancy, it always shows up later as greater demand than what was anticipated. And I thought that's what we heard out of the IEA, is that the demand has been greater than they anticipated. And that's certainly bullish for oil if that's the case. Did I hear that correctly?
They're still looking at demand growth next year of around 700,000 barrels a day. The forecast, it was called their net zero emissions pathway forecast. It would have demand peak in 2030, but if you don't have that, which I think is a more practical case, then their forecast was that demand would continue to increase into 2050. And your question was, they tend to be more on the bearish side for the most part, or more demand is, I think what you were pointing out, demand tends to grow more or creep up more than what they typically forecast.
Right. And that to me is the important, message there,
Yeah.
is that they've underestimated demand, and they're, now starting to revise in that direction.
Yeah, and
Anyway,
it's a lot of moving parts here, but because part of what's kept oil prices up here is the China demand for filling their strategic reserves, which is on the order of around 1 million barrels a day. Which, if that went away tomorrow, would be very negative for oil. But as long as that's in there at 1 million barrels a day through the first half of next year, which I think it will be, that's going to continue to support oil here at around $60 a barrel. But once you know you start to see that further demand growth, we're not that's bullish long term, just given we're not growing oil production for the most part in the U.S. It just continues to slowly creep up. But longer term, yes, demand's going to continue to climb at 500,000 barrels to 1 million barrels a day for the next decade or longer. And that's going to be positive for oil.
given the out of favor nature of your group, you've had some great calls this year, Bob. So correct.
Thank you.
Does Trump have any levers he can pull or will want to pull further? I mean, given the affordability is so, I mean, that's kind of central focus now with the Republicans, given what just happened in New York and Virginia.
I think, you don't know what he's sort of whispering behind the scenes to OPEC, and, his whole drill baby drill mantra for the U.S. really sort of went over like a lead balloon, which we knew it would, just because, the public companies have figured out their best path is to return capital to shareholders and not grow production.
Yeah.
So if he has any leverage, it's just sort of, little arm twisting behind the scenes to keep OPEC to continue to put oil into the market to sort of dampen down anything that might disrupt production elsewhere, other than, the sanctions that he's put on Russia, which, like we said, the market doesn't really view that as a real disruption to supply.
Right. All right. All right. Let's turn this over to you, Charlie. You're looking at some credit card data this weekend. Is that how you spent your weekend?
Yeah, unfortunately, I spent my weekend writing a piece, which I do every weekend, but and I'll probably publish it on Wall Street Beats later this week. But the topic was affordability, which you just referenced, Steve, and I think that's likely to be the word of the day, the week, the month, and the period leading up to the midterm elections next year. And obviously, affordability covers a broad range of topics. You mentioned energy costs as being one, but I think as it relates to the financial system, there are two areas where affordability is going to be reviewed, I guess. And one is housing. I talked about that last Wednesday, and that did get discussion at the dinner last Wednesday between Trump and the Wall Street executives, and some, options that could be pursued there. The one that I think is the most impactful is the one dealing with assumable or portable mortgages. And, I think there will be a legitimate effort to create a market for that, which entails, the GSE's, participation. But if we do get, an adoption of a market for portable or assumable mortgages, that will help the turnover of houses, because there's a lock-in effect where, I think 70% of mortgages are under 5%. And it's unlikely, given, current inflation rates, given the deficit, other factors, the mortgage spreads, that we're going to see, mortgage rates below 5% anytime soon. So having a portable or assumable mortgage would be a huge deal. And the way I've been playing that and suggested, last Wednesday is, to buy the real estate brokers, because you're going to get a housing turnover, but not necessarily new mortgage origination volumes, if you can, port your mortgage with your assuming an existing mortgage. So, Ben has talked about Rocket. I talked about Open Door, Zillow, Anywhere Real Estate, which is HOUS, Remax, RMAX, or there's one other there I forgot. Anyway, Compass, COMP. So that's one way of playing an issue that's going to be very highly visible next year, and that is making the American dream accessible again through affordable housing. So, but
Charlie, is the plumbing? I mean, are the mechanics of this feasible, given how mortgages have been chopped up and sold off? And I mean, is this really, can this happen?
It can actually, but this is the controversy. You may have seen some very violent trading in the GSEs last week. I actually bought them and sold them in one day because they were up literally 20%
Oh my
from
God.
morning to afternoon. But yeah, so the answer is, and this is where it gets controversial. It'll be interesting to see what Bill Ackman has to say on tomorrow morning. But if the Trump administration wants to pursue goals of making housing affordable, he may have to put off IPOing Fannie and Freddie. And so they sold off Monday or late last week on that possibility that the IPO would be delayed. And then Ackman came out and said, no, blah, blah, blah. And he'll give his reasons tomorrow. But so they jumped immediately. Yeah, I think creating a market like that, which exists in Canada, it is feasible, but it just may require using the GSEs as your tool, and if that's the case, they can't be public entities.
Right.
That's the thing we're trying to solve. But the next issue, and this wasn't necessarily talked about at the dinner, but I think at least in my world falls under the question of affordability, and that's has to do with the credit card industry. You may or may not remember that during Trump's campaign, he talked about capping APRs on credit cards at 10%. Now, I have literally no idea or no value added as to whether he's going to pursue that or not. It seems rather heretical for him to pursue, but it's something he did mention on the campaign trail, and so far, he's pursued pretty much everything he talked about on the campaign trail. So it's out there and it's a possibility. But what I do want to talk about is some of the other dynamics in the credit card industry that have been in the news recently. So Jen, if we can go to the first slide. I'm not sure if you can read this, but I'll publish this later in the week. So earlier last week, we had a settlement between Visa and MasterCard with merchants on interchange fees. And I won't go into a lot of detail because it was written about last week, but the bottom line is they agreed to lower interchange fees by 10 basis points over the next 5 years and to adopt a new honor all card policy, which means, in the past, if you accepted one Visa card, you had to accept them all. Going forward under this settlement, you can reject a premium Visa card, which requires a higher interchange fee, and accept a no frills card. So you can, as a merchant, you can distinguish between cards that you want to accept and reject. So the bottom line of that agreement is it is going to put some pressure on interchange fees. What I show you here in this chart is this is the credit card master trust data. So wait, go back to that. Sorry, I just want to mention this. Go back to the first one, Jen, if you can. Sorry. This is the credit card master trust data. And it shows in the top chart delinquencies, and the second chart shows charge-offs for the major credit card issuers. And the bottom line here, and this gets back to some of the dynamics that I think make cards less attractive today than they were 6 months ago. But the dynamics here are we're starting to see a turn in delinquencies, a turn up. So we're at an inflection point, and we're getting more data today as these credit card companies release their master trust data for October. So the October data in this chart is not fully complete, but you can generally see that we bottomed 2 months ago and are slowly inflecting up. Now, what's tough to tell is sometimes this can be just this seasonal norms. Typically, delinquencies bottom in the summer, start to rise in the fall and winter, and then start to fall in the spring. And we're following that pattern. So it's hard to know whether this is just a seasonal or a secular change. But the bottom line is we're going to see higher delinquencies in the card space between now and next February. and that works against obviously the card's profitability dynamics. The next slide, if you go to that, Jen. This shows some of the reserves that are specifically allocated to the card portfolios. And basically, you can see that banks carry loan loss reserves for their card exposure of 7 to 8%. Charge-offs today in the card industry running between 3 and 4% for the banks. So they literally have 1.5 to 2 years of reserves already on their balance sheet. So they're very well reserved for any deterioration in cards. And so I don't expect it to be a major drag if we do see a tick up in delinquencies in the card for the major banks. But they are going to have to provide, and higher provisions are a drag on your P&L. But it's not going to be an outsized drag. We can go to the next chart. Okay, so this is what I was talking about when I talking about reward costs. So banks report on their P&L for public release card revenues as a one line item. But if you go into the regulatory filings, you can break up those card revenues into three pieces. There are the interchange fees, there are the reward costs, and then there's all other. All other being things like late fees, annual fees, balance transfer fees. That all other is a pretty small portion. The major pieces of card revenues in terms of fee income are interchange fees and reward costs. And what you're beginning to see, or not beginning, but what you've been seeing, creep in is that reward costs are increasingly eating up the interchange fees. So if we have further pressure on the gross interchange fees because of this agreement with Visa and MasterCard, and you don't have any relief on the reward side, then you're going to start to see this fee source of revenue under pressure. I don't know if you can go to the next slide, Jen, but this is the slide that shows reward costs as a percentage of gross interchange fees. And basically, we're eating up about 3/4 to 7/8 of all interchange fees with reward costs. And that started, back in 2021 at, let's say, under 70%. Now it's, over 80%. So that source of fee income for the credit card companies is deteriorating. We can go to the next.
So Charlie,
slide.
is that just It's just a customer acquisition cost? I mean, they're cranking up their rewards fees to get more customers in the door.
Exactly, and particularly with these cards. So I'll offer you 3% cash back, or third night free on a 2-night hotel stay. Those types of rewards.
Got it.
And those have grown very rapidly because of the acceptance of premium cards. And those are the cards that probably are at risk under this interchange agreement with Visa and MasterCard. So there could be some market share shifts away from the premium cards towards no-frill cards. When banks offer rewards to their customer, they have to accrue a liability for those rewards, because at some point those rewards are going to be redeemed and the banks have to expense those against their interchange fees. And here I'm showing JP Morgan's reward liability, and it's been growing very, very rapidly at a double-digit rate over a lengthy period of time. And that's because they obviously been incredibly successful with their Sapphire card, and so they're accruing this liability. Every once in a while, a bank like JP Morgan has to go back and reassess how rapidly those rewards are being used, and then do a true-up expense. Because you make certain assumptions about the reward redemptions, and sometimes you find out that those reward redemptions accelerate. They typically will accelerate in a slow economic or recessionary period, because you don't want to use cash, you might as well use your rewards. So if we go into a slow economic growth period or a recession, all of a sudden these liabilities are really going to hit hard, and they act as a contra account. That's what reward costs are to your interchange fees. So think about it. You've got an agreement with Visa, MasterCard that's going to lower your interchange revenues, and then you got reward costs that are creeping up and potentially accelerate. So we've seen a double-digit growth in reward costs or liabilities, but a single-digit growth in interchange fees. So that source of fee income is really deteriorating. And in some recent cases, we've actually seen it turn negative. So we can go to the next chart. I don't know if you can read this, but this is a P&L for JP Morgan's card operation that I calculate myself. This is my own model. And the line item that's in yellow are we call the non-interest yield, NIR, non-interest revenue yield, NIR yield. And that's that fee source of income. And in the third quarter, it was negative. In the 2 prior quarters to that, it was close to zero. And what you're then seeing below that is the yield on spread income. And then below that is the net. And what's interesting, so if you were to add up the non-interest or fee yield plus the spread yield, the spread that you're earning on your credit card revolving balances, you should get to the revenue rate. What's interesting, because we haven't seen this historically, is the revenue rate, which is the total all-in yield, is lower than the spread yield. And that's because the fee income yield has turned negative. Sorry, that's a bit complicated, but I'm trying to give you a sense that there are pressures building in the card industry. So you're basically, the bottom line of this is your entire profitability in the card industry is now coming from the spread income, because the fee income is turning negative.
So what names are most at risk here, Charlie? Are the JP Morgan? It does. I mean, they've got so many other businesses that they can probably absorb it, but I bet there's others that can't.
Yeah, the pure plays obviously are Synchrony, Bread Financial. Those deal with the subprime sector. So if you saw credit deterioration at a time that their revenues were under pressure, that's a vice that you don't want to be involved in. Capital One is also serving a less than prime sector, but they've got some levers to pull with their merger with Discover that can allow them to show good metrics. And then American Express is dealing with the high end, so the credit issues are not as prominent,
not as profound. Yeah.
Yeah.
Okay. All right. Any other banking things we need to be aware of this week? I know we got the minutes on Wednesday. We've got NVIDIA tomorrow. Buffett's buying Google.
I'll quickly mention, because I know we're running out of time, the new capital rules that are being discussed and rewritten are going to come out in waves over the next weeks and months. And there is a supplementary leverage rule that's probably going to come out in the next week or two that will provide capital relief to the banks. Don't get excited by that, because all it does is takes the supplementary leverage ratio, the SLR ratio, out of the equation as a binding constraint. And it gets replaced with the CET1 or the Tier 1 leverage ratio. So it'll read positive on the headlines, but it really will have no impact on banks' excess capital. Down the line, months from now, we're going to get the final Basel-free capital rules, and that will potentially provide some relief for banks. So right now we have a lot of optimism about capital relief in the banking system. I've called it peak optimism, but it's real. I mean, banks are going to be very aggressive buybacks. What I'm trying to understand based on Wednesday's dinner is this is a pay-to-play administration. And if they get relief on capital, what are they going to ask in return? And they're going to ask these banks to support some of their growth policies. So
100%.
That's why I call it optimism, because they're not going to be able to use that excess capital to buy back stock. They're going to have to use that excess capital to support Trump's policies. So
exactly.
Beware of that.
All right. Any other thoughts, Bob, before we wrap it up?
No, that's good.
You good, Charlie?
I'm good.
All right. Good. Let's call it, guys. Thanks for joining us. We'll catch you back here tomorrow. Who's tomorrow? We got Mackie. I think we got Ben and David Maris. So join us tomorrow on Wall Street Beats. Follow us on wallstreetbeats.com, and we'll see you tomorrow. Thanks, everybody.
Thank you. Thank you.
Thanks, guys.
Thanks.
Thanks, Jen. Hey, Bob.
Yes.
Bob, you still there?
Yeah.
I tried